Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the confusing world of corporate finance. Today we're diving into the First Trust Alternative Opportunities Fund's latest filing. And let's just say this one is like a treasure hunt for financial insight, but you might need a special decoder ring to find the real gold. Stick around because we're about to break down what this fund is up to and what it means for potential investors. Before we start, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below because decoding these filings is always more fun with friends. Alright, let's get into it. This document is essentially a big update for the First Trust Alternative Opportunities Fund. Think of it like a yearly checkup for a complex investment vehicle. Its main goal is to grow your money long term by trying to make good returns no matter what the stock market is doing. That is what they mean by positive absolute returns across market cycles. They use a bunch of different money managers to do this, and they're not shy about investing in some less common and riskier areas. They offer two main types of shares, Class A and Class I. The key difference for most people comes down to fees and who pays them. Class A shares have a sales charge, meaning a portion of your initial investment goes to cover sales costs. Class I shares don't have that upfront charge, which is usually better for very large investments. Now, let's look at the actual money involved for Class A shares. There is a maximum sales charge of up to 4.50% of what you invest. That might sound like a lot, but there are ways around it. If you invest $250,000 or more, that initial sales charge is waived. However, be careful because if you sell those shares within a year, there is a contingent deferred sales charge, which is like a penalty of 1.25%. This next number is super important. It is the acquired fund fees and expenses, estimated at 1.75% for both classes. This is the cost of the fund investing in other funds. Imagine paying management fees on top of management fees. It is like having layers of fees, and that can definitely eat into your returns. They re-up front that these fees can change a lot because they depend on how well those underlying investments do. Putting it all together, the total annual expenses for Class A shares are about 4.06%, and for Class I it is 3.30%. That is a significant chunk of your investment going towards fees each year. To put that in perspective, if you invested $10,000, over $400 of that could be eaten up by fees annually for Class A shares. It really highlights why understanding these underlying costs is so critical. This example really drives home the point about fees. For a $1,000 investment in Class A shares with that 4.50% sales charge, you pay out $84 in the first year alone, assuming a 5% annual return. Over 10 years, that adds up to $452 on just that initial $1,000. For Class I shares, which have no sales charge, it is $33 in the first year and $359 over 10 years. The difference is stark and shows the long-term impact of those upfront costs. Let's look at how the fund has actually performed for Class A shares. The net asset value per S-share started around $26.48 in 2025 and ended at $26.71. The total return for the year was 9.11%. That is a decent gain, especially considering the fees. Now, Class I shares have a much larger net asset value, starting at $26.85 in 2025 and ending at $27.12, with a total return of 9.73% for that year. The long-term performance has been even more impressive, with a cumulative return of over 66% since its inception in 2017. This suggests that despite the high fees, the underlying strategies have, at least historically, been able to generate strong returns. It is like a high-stakes game. The potential rewards are high, but so are the risks and the costs of playing. Now, let's get to one of the most important parts of any investment filing, the risks. This fund is definitely not for the faint of heart. They list numerous risks and they make it very clear that you could lose all your money. They're calling themselves non-diversified, which means they can put a lot of their eggs in one basket. So if that basket falls, the impact is much bigger. One of the biggest risks highlighted is the limited liquidity. This fund is an interval fund, meaning it only offers to repurchase a small portion of its shares quarterly. You can't just sell your shares back whenever you want. If too many people want to sell at once, you might only get a fraction of your money back, or you might have to wait a long time to sell it all. This is a substantial risk, and they emphasize that it is only for investors who can afford to have their money tied up indefinitely. They also leverage their investments, which means they borrow money to invest more. Leverage can amplify both gains and losses, while it can boost returns when things go well. It can also magnify losses significantly when things go poorly. They can borrow up to 1/3 of their assets, which is quite a bit of leverage in the investment world. A significant portion of their strategy involves investing in private investment funds. These are not publicly traded, are less regulated, and often have layered fees on top of the fund's own fees. They're also typically very illiquid, meaning it can be hard to get your money out. This adds another layer of complexity and risk to an already complex investment. Because they invest in a lot of hard-to-value assets, they mention valuation risk. This means there is a chance they might not accurately price their investments, which could affect the fund's net asset value and lead to investors buying or selling at the wrong price. They rely on internal committees and external consultants, but there is always a degree of subjectivity and uncertainty involved. They may also invest in non-US securities, including those in emerging markets. This adds currency risk, political risk, and the risk that the markets there are less stable or transparent than those in developed countries. Interestingly, they mention artificial intelligence as a risk. They're concerned that the rapid development and regulation of AI could impact the profitability of companies they invest in, which in turn could affect the fund's performance. It is a reminder that even new technologies introduce new uncertainties. Alright, putting it all together, this fund is designed for sophisticated investors who understand and can tolerate significant risks for the potential of higher returns. It is a complex strategy involving multiple managers, private investments, and leverage, all wrapped up with considerable fees. So, what is my take? First Trust Alternative Opportunities Fund is a serious player in the alternative investment space. The historical performance, especially for Class I shares, is impressive, showing that their multi-manager approach and alternative strategies can indeed generate strong results. However, the high fees, significant liquidity constraints, and the sheer number of risks outlined mean this is not an investment for the average retail investor. It is a high-risk, high-reward vehicle. The fact that they're investing in private funds and using leverage means they're playing in a more complex arena where deep due diligence and a strong stomach for volatility are absolutely essential. The story here is one of complexity and potential reward balanced against significant risk and cost. What is your take on these complex funds? Do you think the potential rewards justify the risks and the fees? Let me know your thoughts in the comments below. If you found this breakdown helpful, give this video a thumbs up. It really helps the channel out, and make sure you're subscribed for more deep dives into the corporate world. And don't forget to join our Discord community linked in the description where we can continue this conversation. Thanks for watching, and I'll see you in the next video.